You're listening to the Big Cast, your source for the latest in financial technology. Brought to you weekly by the Best Innovation Group, with your hosts, John Best and Glenn Sarvati.
Welcome to another edition of the Big Cast. My name is Glenn Sarvati on behalf of the Best Innovation Group, where we like to do cool things with financial technology, and we've got another good one for you today. I find this one to be really fascinating stuff. We'll be speaking to the three owners of Barlow Research, who are a research shop specializing in insights on the small business and mid-market business community. And they're going to be sharing some new findings of some proprietary work that they've done that really, I think, have some but rather eye-opening and somewhat counterintuitive findings that I think you'll find interesting. As always, you can find out more about the Best Innovation Group by checking out our website, big-fintech.com. I will also mention that if you're listening to this just after we've posted it, we have our bi-weekly town hall meeting coming up, the Credit Union Town Hall. That will be taking place, if you're listening again, on right after this drops. We are going to be having our latest session on Wednesday afternoon, February 14th. That's right, Valentine's Day, at 3 p.m. Eastern Time, noon Pacific. If you are not picking this up until after that, you can go out to the website cutownhall.com and listen to a replay. But we encourage you to join live because it is a very interactive session that we like to try to get everybody's opinions and get the best practices in the credit union space. And following up on the Valentine's Day theme, we're asking people to kind of come with their thoughts on what they're particularly loving these days about the activities going on in the market space in the credit union world. So we hope you will join us for that one. Again, cutownhall.com. It is free for everyone to join, but you do need to register in advance, so you'll find a link if you go out to that website. I'm just back from Miami, where I was at the Deluxe Exchange, which has become a real go-to for me. Yes, it is a client conference for the Deluxe Corporation, but beyond that, and that information is clearly there in the breakout sessions and their collaborative lab showing off their products, etc. But in my mind, it's really become a go-to forum for thought leadership, primarily in the financial services space. Small business to some extent as well, but particularly where the intersection of small business and financial services come up, as well as consumer and retail financial services. So I find it to be extremely valuable use of time, and a couple of really great keynote speakers as well. I was there moderating panels on a couple different topics. One, the fraud and security around banking, and also the long tail of the paper check, which will kind of come up in the conversation that we're going to be having with Barlow Research. Again, in particular, given that business checks are the ones that seem to be holding on the most strongly. But encourage you to check that one out in the future. And another person who we saw there, one of the keynote speakers, a gentleman by the name of Zach Cass, who I'd never heard his name before until I saw him posted as one of the speakers here. He is an AI futurist. He actually portrays himself as the chief optimist for AI, and formerly was one of the early employees at OpenAI. So obviously he knows of what he speaks. And he had some additional pieces of kind of tidbits that I found kind of helped frame things a little bit differently. He pointed out that ChatGPT is currently blowing away Moore's Law, the whole law about how chips continue to get smaller and more powerful and double in capacity over time. He says that ChatGPT's advancement in terms of efficiency and power, well beyond Moore's Law at this point. He also made his own prediction. He thinks that AGI, artificial general intelligence, kind of the next stage of sentience, for lack of a better way of putting it, he thinks it's going to arrive by 2030. In fact, he says he's probably being conservative on that. He thinks if he really pushed himself, he could believe more something about the 2027 or 28 range, but he's given himself some cushion. That is a wake-up call, I think. On both sides. I think that some people are thinking it's literally around the corner, the way the advancements have been made. Having said that, 2030 will be here before you know it. And as I said, despite the fact that he says he's the chief optimist, he wanted to try to provide a somewhat balanced picture. One of the things he said along those lines, he also predicts that that artificial intelligence and ChatGPT and things like that are going to eventually become a utility. which brings to question regulation, like most utilities. But the other thing he pointed out, in his mind, the biggest risk of artificial intelligence is that it could solve so many problems that our brains stop evolving because we don't need to continue to push ourselves to deal with these issues. Is that all? Not a problem. It's interesting that this is someone who is the optimist coming up with that. But in total, I don't want to speak unfairly in terms of this. He still is very optimistic about the view of AI and its role in society going forward. He thinks that all the problems that he acknowledges are there can be overcome the same way lots of other problems have been overcome over time. We've been reaching out to Zach Cass. We're hoping to get him on the podcast, so hopefully we'll be able to talk to him in detail about this stuff. But I'll post a link to his website if you want to check him out before that as well and some of the things he has to say. His point about our brains stopping evolving actually reminded me, I've been trying to track this down forever now. I remember from, I must have been in 4th, 5th, 6th grade, something like that, reading a short story back in the 1970s about pocket calculators, right? If they had become somewhat more popular, kind of the era that I grew up in. And it was a science fiction kind of dystopian story where someone was actually in the process of relearning mathematical theory because people no longer understood why math worked the way it did. Why 3 plus 4 equals 7? You just punched it in the calculator and it just came out. And that there was about the whole process of kind of relearning that there was not just pure dependence on these machines. I've yet to confirm, but doing a search, I found that it looks like it could have been a story written by Isaac Asimov back in the late 1950s called The Feeling of Power. Now, the part that throws me on that is when I read the description of that story, it ends with a suicide. It ends with whole military entanglements internationally and intrigue along those lines, probably very in time with the Cold War and the nuclear dilemmas of the time. I have a hard time believing that we had those types of conversations back in a class in 5th grade or so. So either it was a different story or maybe we read an excerpt, but you may want to check that one out. And if anybody remembers another story along those lines, I'd love to know because it's been kind of bugging me for some time what that was all about. Also, taking us a little bit further down the rabbit hole, obituary that I saw in the New York Times just this last week for a gentleman by the name of Walter Shawley. And the headline called him the head geek of the slide rule universe. This is a guy, and again, probably because I grew up right when pocket calculators were becoming more popular, I never learned to use one. I was always just kind of confused as all get out by those things. And kind of similar to this Isaac Asimov story, he was like, these things are important. It's important for people to understand how this stuff works. And he kind of became a one-man campaign with a website and an appreciation society or whatever to kind of keep the slide rule in circulation and have people kind of think about these things. So kudos to Mr. Shawley. Sad news about his passing, but a very interesting story. As I say, I can find an angle on this stuff no matter what we get into. The last thing I'll mention before we jump into our interview that does tie in a little bit more directly, the announcement this week, J.P. Morgan Chase is going to be opening up 500 new branches. We keep hearing about the death of the branch, and if you look down the trends, the number of branches, as we all know, has been declining consistently for well over a decade, probably going on 2 decades at this point. They've announced that they're going in the opposite direction, primarily in new cities, to try to build out their presence in some of the places that they have not had as strong of a footprint. Places like Charlotte, which of course is the belly of the beast with the other big players like Bank of America based there. Minneapolis, I believe, was mentioned, Boston, places like that. This is one of those typical things where I think the headlines don't do justice. I mean, we're going to continue to see declines in branches. If you look at Chase's branches, they're basically flat right now. But over the course of the last 10 years, even they have less branches than before. So this article that I read, particularly in the Wall Street Journal, talks about their love affair with branches and how they're so solid on this strategy. And yes, they are on a relative basis more solid than others, but they're still shedding branches. And if they're coming in to these other cities and areas that I see, they're clearly focused on the higher affluent areas as well. So one of the things that they have found is that branches are still important to a key component of the overall constituency of banking services, which is one of the things we got into with Barlow Research. One of my favorite firms I've learned that has a great level of insight on the small business and mid-market banking communities. That's one of the things they looked at, that you do definitely have a need for branches, and that plays an important role in FI selection when it comes to these institutions. Yui Yang, Sandy Hansen, and Joel Mueller have all done recent research in a variety of different areas, and we touched base on all of them. That they each presented at Deluxe Exchange on this stuff. Fascinating stuff. Wanted to make sure we shared it with you. So let's have a listen. Finding a quiet space here in Miami, Florida, on a evening here at Deluxe Exchange. I'm here with three of the partners from Barlow Associates. Sandy Hansen, Yui Yang, and Joel Mueller, all of whom had separate presentations here during the conference, and all with really interesting stuff to talk about that I think is very relevant to the types of issues that we're always dealing with. Joel, let me start with you. You did a session today about small market or middle market businesses, what the definition of the businesses you were looking at?
Yeah, so the segment that I presented on, we termed it middle market. It bleeds down a little bit into what we traditionally call small business. And at Barlow Research, we define small businesses as companies with $100,000 in annual revenue to $10 million in annual revenue. Middle market companies would be those with 10 million up to 500 million.
So you had a little bit of both of them.
Yeah, we went from 5 to 500, so we're kind of right in the center of it.
And just to step back for a moment, Barlow Research Associates are subject matter experts focused on the small business space, which I've come to learn that you guys have a wealth of knowledge and expertise and data in this space, which is very much needed.
Yeah, we've been around for a very long time. We were founded in 1980. We do specifically voice of the business customer, generally collecting that data through surveys. Been around the block for a while.
So the piece that you're dealing with here is both from if you put it, accounts receivable and accounts payable standpoint. So whether these businesses are making the payments or receiving the payments. But I think a very counterintuitive, but surprising finding for a lot of people is that in both cases, check was the predominant instrument, or at least the plurality, I guess I should say.
It was. So in the study that we conducted, again, is about 800 businesses with 5 million to 500 million in sales. Almost half of their payments that they're making and a little under half of the payments that they're receiving are made via check. So check is certainly a dominant force in the market, a dominant vehicle for making and receiving payables. On the receivable side, as I mentioned, there's a slightly lower percentage of payments being received by check. There's over half of payments are received via some other method.
And it may be by virtue of the type of company, too. The more payments they're getting from consumers may be shifted more. They may be more likely to accept by credit card or something like that.
Actually, what's funny is that consumer B2C businesses tend to receive a lot more walk-in business.
Okay. Where
B2B companies tend to receive more ACH and wire business. So their payments tend to differ. The profile's different.
Yeah.
But your point is right on in terms of vast differences across different kinds of companies. So whether they're B2B, B2C, whether they're smaller on the smaller end of the perspective or the larger end of the continuum, or if they're in a variety of different industries. For example, manufacturing and transportation companies, both of those industries have very different profiles, highly centric to payments, and their payment profiles look a lot different than a services company.
Makes sense. And speaking of service companies, Sandy, you mentioned that you're actually responsible for handling the incoming payments into your business, and you said obviously you're happy to take anything.
Yes.
You'd like to be paid, but
yes,
you have a preference if you had your druthers.
Of course, as do most businesses, I think they have the preference for what's easiest for them to accept, but they're going to take their payment any way they can. So most of our payments, to be honest, today come via ACH, and I think that's probably newer within the last 3 to 5 years. Before that, it was check, and it was a mail. They're mailing in the check to us. Why? We'll take checks. There's no problem with taking checks, but it takes longer for us to get them, and it's more of a manual process. You have to sign them. You have to take a picture of them or go to the bank to deposit them, versus the ACH just appears in your account. So
did it just kind of naturally, organically shift over, do you think, from check to ACH, or did you provide any encouragement, whether through a true incentive or just suggesting it?
Well, I think there's been some natural transition, but I think we also started to suggest that we would love to take your payment via ACH. So there's been some of that as well.
And you mentioned something too that I think was interesting from the study that I conducted, was that the average business in this segment is spending 29 hours in a month just reconciling their payments. And I think that the way that those payments are coming in is a big part of that. If they're really check reliant, obviously it takes a long time to do that as more manual process, where other payments come in with more remittance data, coming in electronically. Again, if they're building in some kind of machine learning or AI into that process, it can go even quicker. But as it sits today, a lot of time is spent on reconciling.
And I think you mentioned at the end of the study, you also said, okay, well, what are your intentions? And obviously people would love to get rid of that reconciliation time. And there is some, there's some evidence that there's going to be more move toward those automation processes.
Absolutely. And it's very much focused on invoicing, especially on the AP side. So I think it was about 40% of businesses had some kind of intentions or plan within the next year or two to automate some process, some type of payment process. Most likely that was through invoicing. What was really surprising, I think one of the things that blew me away from this study, is that 25% of those that had some kind of plan said that it was going to involve AI or machine learning.
That is, well, these days probably everything involves AI or machine learning, but that is interesting that even in this space.
Absolutely.
And as we were just discussing, that doesn't mean the checks are going to go away, because Sandy, as you said, you're going to take money, especially when it's coming in, you'll take it however it's going to come in.
Yeah, I think that's a really important thing to understand too, is that these businesses, most businesses, I should say, are really beholden to their customers and how their customers want to pay them. They will receive anything, like Sandy just said. What you have, we'll take it. It just is going to add more ripples to the pond.
Well, as you had said, we've yet to find a payment type that businesses don't like. I mean,
Absolutely.
They're adding to them. They're not replacing while they're adopting new ones.
Right. And real-time payments is a great technology that many financial institutions are interested in, and it may even help with reconciliation because it'll be instant and all that good stuff. I think that one of the recurring themes we heard today, and I have to believe this, is that in the next 3 to 5 years, the reconciliation and the AI and machine learning is really going to facilitate what that process looks like. I don't even know, Sandy, if you will be spending over 20 hours on reconciling some of these payments here in the next couple of years. So that to me is really exciting, the technology meeting these customers where they are.
And that's been the holy grail for some time, on the business side in particular, where checks have been stickier and they've not declined to the same degree. But that's a great transition, because you're involved in a panel where you're talking about real-time payments, which of course, and again, we're using the phrase basically, interchangeably for both the FedNow and the RTP solution from the clearinghouse, right?
Yeah, absolutely. So the panel is going to be talking about interest and demand in real-time payments, and everybody wants to know, should they cater to these early adopters? Should they wait? And
they being the banks. The banks who are providing the service.
The banks, correct. Should they wait and see what's going to happen and what the demand is? So we're talking about these middle market businesses, 10 million up to 500 million in sales. And our data is telling us that over 52% of them are interested in sending real-time payments. So the data says that there is interest there.
Now, it's interesting. That's to send. Did you also ask about receiving?
We did, and it's right around that 50 percentile as well. Maybe a little bit higher, because everybody wants to receive their money.
That's what I was wondering.
Instantly.
That's one of the things. I mean, there's a sender and a receiver in every case. So it's great if you want to send, but you better have somebody who's going to accept it.
Right. And so I think there's interest on both sides of the house, if you will. But when it comes to some of the demand in terms of sending it, it has to do with cost savings savings. It has to do with transparency of fees. And it also has to do with not having to rely on the Postal Service. At least in the last year or so, the Postal Service has been a huge pain point for many businesses when it comes to payments.
Well, this is interesting, though, because this is a little bit different than the theory that I had. So and I think you mentioned that these businesses, for the most part, a very high percentage are already using ACH, right?
Yes, they are. Over 90% of them.
So is your hypothesis, and I don't know, maybe this actually came up in your study, are the real-time payments more likely to supplant the check payments or the ACH payments, do you think?
I think that remains to be seen. I don't know that I have a crystal ball
Okay.
on which method it will supplant. I think part of it will be ACH. I think part of it will be checks. But there is not enough providers in the ecosystem at this very moment. I think today the Fed Reserve said there were over 400 providers
that's
and
the
growing.
roughly the number that I've seen,
And growing. And that's a good thing. But we have to build out the ecosystem first before we can determine.
And the capability is one thing.
Yeah.
The volume running through those pipes
Absolutely.
is the other.
Absolutely. And the question for real-time payments is, if you build it, will they come? And that's true for every product that we as an industry, anytime we put out a new product, is if we build it, will they come? And it, again, remains to be seen. But I will say that when it comes to middle market companies adopting payments, I think they will adopt this real-time payments product.
You pointed out that there's a paradigm shift in terms
Yeah.
of the way people think about payments that's really fundamental to actually moving forward, though,
Yeah.
which I think was fascinating. So I hadn't really thought about it the way you described it.
Yeah. So the one of our data points has to do with we asked them to pick their preference. Do you prefer faster delivery and settlement, or do you prefer float between payments and settlement? And surprisingly, what we found was that 65% of these middle market businesses said that they prefer the float. Now, I would have expected that the other way.
This is as a sender, or this is as a recipient? Or?
This is as a sender.
Okay.
Yes. So what this tells us is that there needs to be re-education about where that float sits. There needs to be, the value proposition needs to be proven. The fees have to be really transparent. And the real-time payments have to work with the current solutions that are already in place, right? I think that's one piece we haven't really talked about, is that now we have these real-time payments, and how will they work with the accounting software systems, the ERP systems, and all these different solutions that businesses are using.
So, I mean, one of the things, as we talked about before we started recording here, is the notion of where does that float exist. It doesn't really go away. It just kind of shifts in terms of where in the overall process it exists.
Right, and I think that's an important point, is that the float is still there. Historically, businesses, when they make payments, they're used to having the float after they've made the payment.
They quote unquote made
After,
it, either
yes.
put it in the mail,
Right.
or even in the case of ACH, until recently was same day, at
Right.
least it's still sitting there for a day. or
Yeah,
two.
it's still sitting there. Now with real-time payments, businesses get the float ahead of time, right? So it's re-educating them about how they make payments and getting them to buy in on that value
And then
proposition.
as the recipient, it's the surety of payment, because it's
Absolutely.
going to come, and it will most likely come on the due date, because
Right.
now you know it's going to show up,
Yeah.
so you don't have to leave that cushion to make sure it does.
Exactly. No more guessing.
Yeah, that's interesting stuff. It'll be, again, it's a long path to full adoption and ubiquity, but it'll be fascinating to watch how that happens.
Yeah, and for financial institutions, they can't leave money on the table, right? So there are going to be customers that are early adopters, and there are going to be customers that don't want anything to do with real-time payments. But for financial institutions, they really have to know their customer base to identify how early they need to be adopting real-time payments. I think that's a key.
And at the same time, as we started off by saying, it's not going to get rid of another form of payment, it's going to add a form of payment.
It will add to the ecosystem,
And
yes.
hopefully in a value-added way, that it doesn't wind up just becoming another cost center that they have to deal with. Speaking of which, Sandy, one of the conversations, you kind of went across three main trends that you're seeing in the business space. One, in terms of switching financial institutions, really harkened back to what happened almost a year ago now with the failure of some meaningfully sized regional banks, and how that kind of set the process in motion around people shopping not just for higher rates, but also for greater security of their deposits.
Yeah, and we saw that early on in April, we saw that almost 50% of small businesses and a similar number of middle market companies said that they did take into consideration the FDIC limits when considering where they were holding their funds and making sure that they wanted to make sure that their funds were secure. So we saw that in the marketplace quickly. I think by the summertime, though, that sentiment had really changed as far as if they'd already moved their money. Did they take those bank failures into account when deciding how much and where to move their money? Those figures dropped. So that sentiment and the media news, yes, it was in the back of their mind, but it wasn't actually the trigger. It maybe got them to start thinking about moving their money, but really the big trigger was the rates.
Which, just happened to be at the exact same time.
Yes.
And you had some interesting kind of flashpoint kind of analysis of, how much it took for people to really start saying, this is probably worth my while to give it another look.
I think it's 68% of small businesses, a little less so in middle market because they were already earning higher rates, but they didn't believe that they were getting a competitive rate on their deposit accounts. So when
because they weren't.
Because they weren't, and many of them weren't. We had figures on that as well. I think it's like 60-some% of small businesses, again, less so in middle market, but they were receiving under 2%.
And I think what I remembered seeing was it was like about a 3% that was enough of an inducement to say, okay, this is worthwhile for the disruption?
Yeah, 3.3% in small business is what they said would get them to consider moving funds, and I think it was 3.2 in middle market, which are figures that were not unheard of, are still not unheard of, that they can get if they're moving their funds.
Exactly. One of the other things you talked about was the rise of what you called the mid-sized banks, which you defined for this purpose as $1 billion up to about $50 billion.
$1 billion to $50 billion, correct? Medium-sized institutions.
But what I thought was interesting was they seemed to be, taking market share not from the big banks, but from the sub $1 billion banks.
Yeah.
And can I, given that our audience is heavily credit union, kind of centric, is this literally banks, or is this financial institutions inclusive of credit unions as well?
So credit unions we would code separately.
Yeah,
so
I thought you had kind of like an other category, right?
Yes. So we're really looking at it as those small community banks, less than $1 billion in assets, and that's really when you're looking at the segments in whole. Small business, 100,000 to 10 million. Middle market, 10 million to 500 million. The medium banks are gaining at the expense of the small community banks. That's because some of them, yes, are closing. Some of them are going out of business. Some of them are being merged together
into becoming a $1 billion institution, right?
So we're watching all that. But also it's the medium-sized institutions have really high service levels, and where they're especially gaining and where they are gaining at the expense of large banks. So when we look at the segments as a whole, it's at the expense of the small. But if you look at the 2.5 to, let's say, 25, that is where we are seeing loss of share from large banks, and it's medium banks picking it up because they're offering the personalized consultation, the personal connection, but they also are able to provide the credit that is needed in that segment.
And that's the key, I guess, that when you start getting to the sub-billion, that's where you may not have the same ability to provide the credit. Mm-hmm. But and the numbers were pretty striking. I mean, kind of across the board, when you looked at what the businesses were saying, did they have a dedicated account rep? Mm-hmm. Were they getting quick resolution, et cetera? And it was consistently better for those 1 to 50 billion versus the bigger ones.
Yes.
The piece that I found fascinating, though, is it didn't seem to be digital capabilities.
Well, the digital capabilities, we always hear about the large banks have the best platforms, and they do. They're very robust. They have all the features and functionalities. But what we're seeing is that the medium bank customers are just as satisfied, if not more so, many times on online banking and mobile banking as the large bank customers. Now, that could be a little bit about, where they're deciding to bank and that they're just happy with what they have. But I think for the majority, especially when we're talking about small businesses, which are mostly made up of micro companies, 100 to 500, they don't need all the bells and whistles.
Right.
They need the basics, and they need the basics to work.
And they're good enough at the 1 to 50.
Right.
But the piece that also that you didn't say, but we talked about this afterwards too, kind of by process of elimination. If the big banks are holding serve, and it's not because of digital capabilities, it's probably because of the branch network.
Yes.
Which is pretty amazing given that everybody's talking about the branch is dead. Well,
Yeah.
guess what? It still actually has value.
Yeah, and as we saw in that market share slide, the large banks, as a whole, they're really not losing that much share. Maybe slightly down in the middle market when you're looking at the segments as a whole. It's especially, again, with the micro companies, which are so branch dependent, they're looking for convenience. They're looking to bank when they need to bank, which might be, the digital capabilities, et cetera. But especially the branch networks, where that's really bringing those customers in the micro segment. That's, what the large banks have to really offer, I would say, in addition to the digital capabilities, but where they might not need all those advanced features. It is, I think, the widespread branch networks that's bringing those companies
And I
in.
remember one of your slides showed a decline in the frequency by which, or maybe not the frequency, but at least the percentage of businesses that actually visited the branch. But the telling piece was even after the decline, the lowest level of, I forget what the three categories of businesses, was still at like 74%.
Yeah,
That's still a pretty high reliance.
That we were looking at by age of the owner.
Age of the owner, that's what it was.
Yeah, so the younger owners since the pandemic have been the ones exiting the branch. They're using it. Few of them are using it.
But still.
Still 3/4 of them use it. So that shows you, even those younger owners who we think they're all about digital, they still do use the branch.
And speaking of the age of owner, that was the other point that you made that I thought was interesting. We've talked before on the podcast about the great wealth transfer. And I guess this is kind of a corollary to that, and that's the great change in business ownership. Because kind of amazing, and I think you and I may have talked about this when we met last year too, the average age of a business owner is just kind of mind-boggling.
63 in both segments, small business and middle market, and that average age has slowly ticked up. But I think what's more dramatic and more impactful is the percentage of owners in the 65 plus category.
That was the single biggest.
Yes, we have now exceeded. There are more business owners in both segments in that 65 plus category than there are in the 45 to 64. So we're over half at half the market for small business, over half the market for middle market companies in that 65 plus category. It's a fact of life. Nobody lives forever. They are going to have to start making transition
even with AI,
plans.
it's not going to happen.
Even with AI,
Okay.
yeah.
Oh well.
So but and many of them do. Many of them do say, yes, I'm going to have an ownership transition in the next 5 years. But when you dig further into it, only a quarter of small businesses say that they actually have a succession plan. It is higher in middle market. Middle market has to be a bit more planned out. There's likely boards and things involved. But for the small businesses, only a quarter. While half of them are 65 plus, only a quarter say they actually have a succession plan.
And the other piece that really struck me on that is we always talk about financial institutions as the trusted advisor. But in this case, as you point out, the trusted advisor for those types of conversations is much more likely an accountant or a lawyer.
Right. Yes.
And that's where the deposit relationship or the broader banking relationship winds up, being, in jeopardy.
Yes, potentially lost, because if they do sell their business, they're going to come into some wealth. As a financial institution, you want to keep that into your wealth management side of the business. So if we don't know these transactions are happening, we have a chance of losing that. But I think for financial institutions, what's maybe more important is if we aren't aware of the change that's coming, we don't have a chance to meet the potential buyer who's going to need financing.
Yeah, it's another not only a save opportunity,
Yep.
but a new transaction
customer.
opportunity. Speaking of which is one of the pieces I find fascinating, is you've actually experienced this all yourselves. You are now all part owners of Barlow Associates because your founder, John Barlow, retired, and this was his succession plan, right? As of, year and a half ago? I forget how long ago it was.
Since about the year 2020, we've been in a transition. So, we're
What
working
timing?
through that.
Just in time for the
Yes,
pandemic.
yes.
Wonderful.
So, yeah.
So, fascinating stuff. I love talking to anybody with data that can really back this stuff up. But the categories that you get into and the insight you bring to it is wonderful. If people want to understand more about what you have to offer, I know you've got some models or presentations out available freely on your website, and then obviously more conversations. What's the best way to?
Absolutely. They can reach out to us from our website, www.barlowresearch.com, or they can reach out to our main telephone number, 763-253-1800.
I can't remember the last time somebody offered a telephone number as a contact. That's amazing. Sandy Hansen, Yue Yang, and Joel Mueller, thank you so much for taking the time. This has been great, and I look forward. You do a small business. Is it more for the bankers? You do a conference, right? Your own conference.
We do a conference, yes, for mostly financial institutions, but industry partners as well. We have a lot of marketing folks, research folks, and product folks that come too.
And that'll be later in the year. When is it?
May 21st
coming up pretty
in
soon.
Columbus, and then we are doing another one November
12th in Charlotte.
Yes.
Okay, well, I will definitely put put the link to that out there as well.
Please do.
Thanks so much.
Thank
Thank
you.
you.
Appreciate it.
So one of my favorite little twists about that as well is that we're talking about the aging population of small business owners and the challenges about succession planning and a transition plan to the next generation. So Barlow Research just lived through that themselves, and Sandy, Yua, and Joel had been long-term research associates, and obviously taking on additional responsibility. And when the founder of the firm, John Barlow, decided that it was time for him for his own transition strategy, he still is involved. You'll see him on the website if you go visit the Barlow Research website. But they have become the owners of the firm and carrying the torch forward, and I think they do great work. So with that, another episode of the Big Cast in the books. My name is Glenn Sarvati. You can track me down via my firm, 154 Advisors. You can find me on X or LinkedIn. You'll find the Best Innovation Group on X at Big FinTech. You'll find our Grand Poobah, John Best, at JB FinTech. Find them both as well on LinkedIn. You'll find us here every week with new content on the Big Cast. Got another interview that I'm all excited about recording in just a couple of days, and we'll have that for you next Tuesday. Lots of new content, and as always, we've got the conference season coming up. Thanks to our sponsors at CUNA, or America's Credit Unions, I should say. The Government Affairs Conference, which John and I will both be at, moderating we're moderating one panel together, and I'm doing another one separately from him. And hopefully, if you're going to be around, definitely track us down. We'd love to talk to you out in Washington, D.C. coming up in early March. You can always find us via the website again, big-fintech.com. Go to the media tab. You'll find all the replays of the past episodes, and you can drop us a note there as well. And you can find our episodes wherever you get your podcasts, Apple Music and Spotify being the usual suspects, but they go far beyond that. Hope you'll check us out. As I say, new content every Tuesday. And if you would love a reminder of that, please subscribe, like, whatever it takes at the site that you track it down. Hope to see you again next week. And as always, thanks for listening.
Check back each week for the latest from the Big Cast. Or better yet, we hope you'll consider subscribing for free via Spotify, Stitcher, Apple, or wherever you get your podcasts. If you have questions or comments, we'd love to hear from you. Tweet us at Big FinTech, email info@big-fintech.com, or visit us at big-fintech.com and click on the Media tab, where you can post a comment or check out our archive of hundreds of past episodes. See you next week.